Hello viewers, welcome to my channel. I'm Hasham. So now in this video, I'm going to explain you about the short questions and MCQs on the topic irrecoverable debt. Last video, I have explained in detail regarding the concept, meaning of irrecoverable debt, meaning of allowance for irrecoverable debt, why irrecoverable debt will be written off, what is the purpose, what is the effect. What is the effect of writing off irrecoverable debt and making allowance for irrecoverable debt on the income statement and statement of financial position? All these things I've explained in the last video. So if you have not watched the first video, theory video, you cannot be able to understand the problems. So my suggestion, if you want the complete command on the subject, watch the first theory video. Be acquainted, clear in your mind regarding the irrecoverable debt concept. Then you come to the problem. Now, before starting the problem, I expect my viewers to take a printout of the problems which I have given in the link under my description. So below the video, you'll find the description. Last line of the description, you'll find the link of these problems. So take a printout and keep it ready before watching the problems. Otherwise, you cannot be able to understand without having the problems. And take a screenshot of the notes which I have written on the board. After that, each and every point I am going to explain. MCQ and short answers, short questions. The first short question I am reading out. Explain the meaning of irrecoverable debt. Second, irrecoverable debt recovered. And third, allowance for irrecoverable debt. In examination, you may be asked in 1 or 2 marks short questions regarding the meaning of the term irrecoverable debt, meaning of irrecoverable debt recovered, and allowance for irrecoverable debt. First of all, irrecoverable debt means the debt which is irrecoverable debt. Irrecoverable. That means the customer, the credit customer is not in a position to pay the amount. The amount is owing by the credit customer and the credit customer is not in a position to pay the amount. So we will write off the debt as irrecoverable debt. So here you can see irrecoverable debt, amount owing to the business which will not be paid by the credit customer. Amount owing to the business by a credit customer, and the credit customer will not make the payment. That is called irrecoverable debt. Irrecoverable debt recovered. That means amount received from the credit customer whose debt was already written off. So first, the debt was already written off. Later, the credit customer has paid the amount. That is called irrecoverable debt recovered. In specific meaning, amount received from a credit customer after the amount was written off as bad debts or irrecoverable debt. So first of all, the business has written off irrecoverable debt. Later on, the credit customer has paid the amount. That is called irrecoverable debt recovered. Now, allowance for irrecoverable debt. An estimate is made about the amount of irrecoverable debt which may happen. It is not the actual loss, it is the expected loss. That means a business will estimate how much may become irrecoverable on an estimate basis, on a guesswork basis. So here an estimate of the amount which a business will lose because of irrecoverable debt. So the difference between irrecoverable debt and allowance for irrecoverable debt. Irrecoverable debt is the actual loss, whereas allowance for irrecoverable debt is an estimated loss. That is the main difference. Now, second question you can see, suggest 2 ways in which the risk of irrecoverable debt may be reduced. Every business wants to reduce the amount of irrecoverable debt. We cannot eliminate. The irrecoverable debt cannot be eliminated because definitely when we sell the goods to customer, it may happen that some of the customer may not pay the amount. So always In some businesses, the irrecoverable debt will be more. In other businesses, the irrecoverable debt will be less. But normally, irrecoverable debt is there. But every business will try to have lower irrecoverable debt. If the business is having high irrecoverable debt, means the business is losing the money. The business will incur loss by having more irrecoverable debt. So the business should try to minimize the irrecoverable debt. How the business can be able to reduce the possible irrecoverable debt? There are different methods. Only two methods it is asking, but for the sake of our knowledge, I have given nearly 5-6 causes I have given, so that you can be able to remember at least two. First one, reduce credit sales. Higher the credit sales, higher will be the irrecoverable debt possibility. If you want to reduce the irrecoverable debt, reduce the quantum of credit sales. If you sell more goods on credit, possibility will be more. So that's why try to reduce the credit sales. Next one, obtain references from new credit customer. When a new credit customer comes, we should ask the new customer to give the references, because we want to be sure that the amount we will recover from that credit customer. Otherwise, blindly, without thinking, if we indiscriminately sell the goods on credit, then definitely, naturally, the credit, that irrecoverable debt will be more. So before selling the goods on credit, we should ask the credit customer to provide some assurance, to provide some references. Next, third one, fix a credit limit for each customer. See here, there are advantage as well as disadvantage of credit sales. If we indiscriminately sell the goods on credit, then definitely, naturally, irrecoverable debt will be more. So we will fix the limit. For each customer, we will fix the limit that we will sell the goods only this much, not more than this. For example, Mr. X is a credit customer. According to past experience, we know that we cannot be able to sell huge amount of credit sale to Mr. X. We will fix a limit. In this way, our irrecoverable debt can be reduced. Next one, improve credit control. See here, once goods are sold on credit, the business should not keep quiet and wait till the customer comes and pay the amount. The business has to make the arrangement how to collect the money from the credit customer. There should be a proper arrangement, like follow-up procedure, giving the reminders, sending the statements. So credit control should be effective. Then the irrecoverable debt will come down. Next one, issue invoices and monthly statements periodically. Periodically, monthly or fortnightly, statements should be issued to the credit customer that your amount is becoming due on so and so date. Please make the arrangement. Like this, reminders should be given. Statement of account should be given to the customers. The next one, refuse further supplies until outstanding balances are paid. Sometimes we tell to the credit customer, first you clear off the old dues, then only we will sell the further credit sales. Like this, these are the possible, steps which can be taken by a business to reduce the irrecoverable debt. By following these steps, it is asking in the problem only 2 ways you have to suggest, but I have explained 6 possible ways so that you can be able to remember. Next one is third question. Explain why maintaining a provision for irrecoverable debt is an application of principle of prudence. That means this irrecoverable debt is applied, is written off, following the accounting concept of prudence. What the prudence says, record all expected losses but don't record any expected gain. Playing safe or accountant should be cautious. That means the income statement should not be overstated. The income should not be overstated. If we do not make irrecoverable debt provision, then definitely our income will be overstated. At the same time, income will be overstated and financial position, trade receivable will be overstated. The prudence concept says the income should not be overstated. The trade receivables should not be overstated. So that's why we make this irrecoverable debt allowance provision to to reduce the income, to reduce the trade receivable. That is the reason. Next, fourth, it is a MCQ. First three questions are theoretical short questions. The fourth one is multiple choice question. Four choices, four options are given. One option we have to select. Which statement is true? Here we are given irrecoverable debts are deducted from trade receivable after the allowance for irrecoverable debt is calculated. That means first allowance for irrecoverable debt should be calculated, then irrecoverable debt should be deducted. It's wrong. Second, irrecoverable debts are deducted from trade receivables before the allowance for irrecoverable debt is calculated. Absolutely right. So from trade receivable, first we should deduct the irrecoverable debt. After deducting irrecoverable debt, then we have to calculate allowance for irrecoverable debt. So B answer is correct. Fourth, B answer. Irrecoverable debts are deducted from trade receivables before the allowance for irrecoverable debt is calculated. So from trade receivables, first deduct irrecoverable debt, then deduct allowance for irrecoverable debt. This is true. Fourth completed. Now I am coming to the fifth question. Again there is an MCQ. Hero wishes to increase his allowance for irrecoverable debt at the end of the year. How does he record this increase? Previous video theory I have explained you the journal entry regarding increase in irrecoverable debt. When a business wants to increase irrecoverable debt, allowance for irrecoverable debt, what is the entry? Here entries are given: debit entry, credit entry, A, B, C, D, four options are given. First option, irrecoverable debt debited, allowance credited. Second entry, allowance debited, irrecoverable debt credited. Third, income statement debited, allowance credited. Last one, allowance debited and income statement credited. Previous theory I have explained you. When we want to increase the allowance for irrecoverable debt, the entry is income statement debit, allowance for irrecoverable debt credit. Remember this. When we want to increase the allowance for irrecoverable debt, income statement debited and allowance for irrecoverable debt credited. The C answer. So for fifth question, C answer. Entry for increasing allowance for irrecoverable debt, debit income statement and credit allowance for irrecoverable debt. Now sixth question. Again we have MCQ, but some calculative part is there. On 1st April 2020, Ahmed had an allowance for irrecoverable debt of $290. The following journal entry was made on 31st March 2021. Year begins from 1st April 2020 and year ends on 31st March 2021. Beginning of the year, allowance was $290 and end of the year, the journal entry passed for allowance is allowance for irrecoverable debt debit $25 and income statement credit $25. It is asking you what was the allowance for irrecoverable debt deducted from trade receivable in Ahmed's statement of financial position on 31st March 2021. Remember carefully. A, $25, B, $265, C, $290, D, $350. Four options are given. Beginning of the year, the allowance was $290. End of the year, the entry made was allowance account debtor to income statement. When allowance is debited, the allowance will get reduced. Note down this point, very important point. When allowance is debited, allowance will decrease. When allowance is credited, allowance will increase. So here, end of the year, allowance was debited. Allowance account debit, allowance for irrecoverable account debit 25. That means allowance will decrease. End of the year it will decrease. The beginning of the year, how much was the allowance? 290. From 290, deduct 25. You will get 265. So end of the year, allowance for irrecoverable debt will be $265. So this $265 will be deducted from trade receivables in the statement of financial position. So beginning of the year 290, end of the year entry passed where allowance was debited. So when allowance is debited, it is reduced. So 290 minus 25, 265. B answer is correct. So here, B, $265, allowance for irrecoverable debt on 1/4/2020, opening 290. The entry made on 31st March 2021 is allowance for irrecoverable debt debit, income statement credit. When allowance for irrecoverable debt is debited, it means that end of the year the allowance has decreased. When allowance is debited here, it means that the allowance has decreased at the end of the year. So now subtract, therefore allowance for irrecoverable debt at the end of the year is 290 minus 25, 265. That is the answer. Next, seventh question, again MCQ. Why does a business maintain an allowance for irrecoverable debt account? Why the business will maintain allowance for irrecoverable debt account? 4 options. First, to apply the accounting principle of prudence, to avoid profit for the year being understated, to have an accurate forecast of debt which will be uncontrollable, to reduce expenses for irrecoverable debt in future. The first answer, A, is correct. To apply the accounting principle of prudence. In theory video also I have explained you that irrecoverable debt will be provided following the accounting principle of prudence. That means the accountant should be cautious while recording expenses and sales. The income should not be overstated and financial statement should not be overstated. That's why we have to provide irrecoverable debt. So A answer is correct here. The business maintains allowance for irrecoverable debt account to apply the accounting principle of prudence. Next, 8th, again MCQ. Where is the balance of irrecoverable debt account transferred at the end of the year? At the end of the year, balance means difference between opening and closing. Opening allowance and closing allowance. The difference between opening and closing allowance will be transferred. Where? 4 options are given. Income statement A, B, payables ledger control account, C, receivables ledger control account, D, trading account. See here. The increase or decrease in allowance for irrecoverable debt will be transferred to income statement. Already this point I have explained in the theory video. We compare the opening allowance with the closing allowance. If the closing allowance is more than opening allowance, there is increase in allowance that will be taken in expenses in income statement. If the closing allowance is less than opening allowance, that means allowance has decreased. This decrease will be added to gross profit in income statement. So whether increased or decreased in allowance, that will be adjusted in income statement. So here answer is A, income statement. The balance of irrecoverable debt account is transferred to income statement at the end of the year. 8th completed. 9th. What entries would be made to record a decrease in allowance for irrecoverable debt? Just now I told you. We have to compare the opening with the closing. If the closing allowance has decreased, then what is the entry? Allowance should be debited, income statement should be credited. Allowance for irrecoverable debt debit, income statement credit. This entry will be passed when there is a decrease in the allowance for irrecoverable debt. So here answer is B. B answer. Account to be debited is allowance for irrecoverable debt. Account to be credited is income statement. Here I am. The entry to record decrease in allowance for irrecoverable debt is allowance for irrecoverable debt debit, income statement credit. Next, 10th question. Bina maintains an allowance for irrecoverable debt at 3% of the trade receivable at the end of the year. On 1st September 2019, the allowance for irrecoverable debt was 900. 1st September 2019, beginning of the year, allowance was 900. On 31st August 2020, end of the year, the trade receivable was 42,800. And which journal entry did Bina make on 31st August 2020? Which is the income statement. First of all, we have to calculate what is the closing allowance. At the end of the year, how much are the trade receivable? 42,800 is the trade receivable. What is the percentage of allowance maintained? 3%. So we calculate 42,800 into 3 by 100. So 42,800 into 3 by 100. You will get 1284. 1284. This is the allowance at the end of the year. Beginning of the year, how much? 900 was the allowance. So beginning of the year, allowance was 900. End of the year, allowance is 1284. So allowance have increased from 900 to 1284. Allowance has increased. When allowance increased, the entry will be income statement debit, allowance for irrecoverable debt credit. This is the entry for increasing the allowance. Here increased. So you can see allowance for irrecoverable debt is 3% of trade receivable. That is 3% of 42,800. End of the year. 42,800, 3 by 12, 1284. Then balance of allowance for irrecoverable debt at the beginning of the year is 900. Beginning of the year 900, end of the year 1284. Therefore, allowance for irrecoverable debt increased at the end of the year. 1284 minus 900, 384. $384 is the increase in allowance at the end of the year. The entry will be income statement debit. So you see, the entry is income statement debit 384, allowance for irrecoverable debt credit 384. That's all. So which answer? A answer is correct. Income statement debit 384, allowance for irrecoverable debt credit 384. A is the correct answer. Now 11th question. The balances in the books of Jason on 1st July 2019 included the following. Trade receivable beginning of the year 64,200, allowance for irrecoverable debt 1284. Trade receivable at 30th June 2020 where $58,500, of which 500 should be written off as irrecoverable debt. The beginning of the year trade receivable 64,200, beginning of the year allowance was 1284. End of the year, the total trade receivable are 58,500. In this, 500 rupees are completely irrecoverable. Jason wants to maintain his allowance for irrecoverable debt at 2% of trade receivable. So this sole trader, this businessman, he wants to maintain allowance for irrecoverable debt at 2%. Then what was the change in the allowance for irrecoverable debt on 30th June 2020? What is the change in allowance for irrecoverable debt? Change means whether it has increased or decreased. So four options are given. A option $114 decrease, B option $124 decrease, C 376 increase, D 386 increase. Now we'll calculate. First of all, from trade receivable, deduct irrecoverable debt. First you have to deduct irrecoverable debt. After that you calculate allowance for irrecoverable debt. So the trade receivables at the end of the year, that is 30th June 2020 is 58,500 less irrecoverable debt written off 500. $500 is the irrecoverable debt. Deduct $500. So 58,000 remaining. On this 58,000, allowance for irrecoverable debt 2%. So allowance for irrecoverable debt at the end of the year, 58,000 into 2 by 100, 1160. 1160 is the allowance at the end of the year. Beginning of the year allowance how much? 1284. Allowance for irrecoverable debt at the beginning of the year is 1284. Beginning of the year 1284. End of the year 1160. There is decrease in allowance. There is decrease in allowance by how much? Therefore, allowance for recoverable debt has decreased by 1284 minus 1160, $124 decreased. So which answer? B. B answer, $124 decrease. The change in the allowance for recoverable debt is 30th June 2020 is $124 decrease. Answer is B. That's all. Next, 12th problem. This is the last problem for this video. A trader sold goods to Zahid on credit. Zahid failed to pay the amount owing and was written off as irrecoverable debt. Zahid is a credit customer. The business sold goods to Zahid. He is a credit customer and the amount due from him. What entries will the trader make to write off as irrecoverable debt? This amount is due. Amount is not given, but amount is due from Zahid. Now we cannot be able to receive any amount from Zahid. We want to write it off as irrecoverable. Irrecoverable debt is a loss, and all losses should be debited. Remember this point. All losses should be debited. So irrecoverable debt should be debited. From whom we have to get the money? Zahid. So Zahid account should be credited. The correct entry will be irrecoverable debt debit, Zahid credit. The correct answer is B. B answer, irrecoverable account debit, irrecoverable debt debit and Zahid credit. The entry for writing off an irrecoverable debt is irrecoverable debt debit, Zahid credit. That's all. So I have completed 12 short questions and MCQs on irrecoverable debt. Inshallah, the next question will continue in the next video.